Well, thank you. It's really an honor to be here. Your organization and its membership have tremendous influence in this sector, and it's really a model of advancing members' interests in the retirement area and the many services that the organization provides and policy positions it helps advance. So I'm a vice chair with the Ontario Securities Commission, obviously a provincial agency, although you probably know that we're supporting the effort to create a cooperative markets regulator that would include a number of the provinces and include the systemic regulation that would be under federal powers. So that's an initiative that's been taking years to accomplish, but it's one that we're continuing to support. So I guess we'll be on the if that's accomplished, we'll be on the just on the edge of the federal family, and it's something that we're really trying to advance and look forward to. So, oh, closer?
Yeah, a little closer. Can everybody hear?
Yeah. Okay. Thanks. Yeah. No, it's only makes sense if you can hear me. So thank you. So our mandate is clearly first and foremost investor protection. And then also the integrity of markets, and also promoting efficient, appropriate capital raising techniques to advance corporate development in Canada as well. But investor protection is really central to our DNA, and that's our first and foremost goal. So Ontario, just in terms of its role in the regulatory landscape, Ontario-based listed issuers, it's probably not a surprise, but they account for about 50% of Canada's equity market value. We have in Ontario 1,280 registered firms, and that's really a remarkable number because you just think about the bank-owned dealers and you don't think of the many smaller exempt market dealers or portfolio management firms. They're also registrants, but that's a considerable number. And the number of registered individuals that we're responsible for that you would deal with in seeking advice, 67,300 registered individuals in Ontario. It's obviously, it's also, that's a significant constituency in its own right from a political standpoint, by the way. Those advisors also seek to influence the public policy debate quite appropriately. But it's, they're leaders in their communities and they're very important to your welfare. Ontario is the principal regulator for over 80% of all Canadian mutual funds. So we have a particular expertise in the mutual fund and ETF sector. We're also responsible for the primary oversight of the Toronto Stock Exchange. We're the primary securities enforcer, along with the self-regulatory organization. So in 2016 to 2017, that fiscal year, we had 48 proceedings in which sanctions were administered. We also had 4 criminal prosecutions leading to significant jail time that were referred to the Crown, and we had, which is unique to Ontario, 3 no-contest settlements with firms in the financial services sector that returned over $143 million to investors. No other province, actually, a provincial securities regulator has adopted a no-contest settlement approach which accelerates returns to investors under those plans. So obviously, talking about the best interest standard, I wanted to talk about a number of priorities of the Commission, and probably there are 2 embedded commissions and the best interest standard that are first and foremost on our priorities. And there's a difference in view across the country, and in this sense, perhaps we suffer from not having a national securities regulator. So at the moment, the only 2 provinces that are committed to a best interest standard as a duty of care in dealing with investors, through financial services firms are New Brunswick and Ontario. There are a number of provinces that are on the fence, and at the moment, British Columbia, Alberta, and Quebec have not supported it. They support a different approach that we refer to as targeted reforms. The targeted reforms cover much of the same area as a best interest standard, but in our view falls short of actually establishing that very high standard that professionals should adhere to in giving advice to their clients, regardless of the profession involved. One assumes, and I think most people probably in this audience, although I'd say actually I would have said that in this audience perhaps many people would just naturally assume that advisor would be required to act in the best interest of the client, but that's probably true of less sophisticated audiences, and you know that advisors fall short of that responsibility today. The standard of the duty of care at present is to act fairly, honestly, and in good faith, which is an important element in a fiduciary standard, but it doesn't take that extra step of saying, you can't act in your own self-interest, that conflicts of interest need to be avoided. It doesn't really raise the standard beyond a level that truly hasn't been, even in its own right, rigorously enforced, and hasn't ensured that that clients get the best recommendation, the best advice, rather than conflicted advice. So the targeted reforms that are advocated by other provinces include certain elements of what we're trying to accomplish, but with best interest, but don't go all the way. And I can kind of compare that. So, essentially in the conflicts of interest area, there are a number of conflicts that arise. One conflict just arises from the structure of the Canadian securities industry, where the bank-owned dealers are a dominant factor in the Canadian marketplace and overwhelmingly will sell bank-affiliated products. Often, if those products are being sold out of a bank branch, it's truly a sales effort. You could say those individuals are salesmen and salespersons. So it's really a case where investors are being sold rather than receiving advice. And if your shelf of available products only includes the products on that shelf, inherently the advice is conflicted and a best interest duty will be difficult to attain. What we're going to try and do is, we're not going to say that there can't be affiliation. That's too large a project and involves too many issues of kind of financial economics to accomplish for a securities regulator. But we can say that when a bank is putting together their shelf, they have to compare those products rigorously with competitive products. And when they make a recommendation, they have to be sure that their funds, really stack up as in the best interest of the client in relation to competitive products. And that necessarily will have to include an analysis of cost. As we all know, cost in investment advice erodes returns and can be one of the most significant factors in not having the asset growth necessary to support retirement. And as the Warren Buffett quote indicated, in fact, passive investment on a low-cost basis can be a very attractive proposition for investment, and it's very difficult for any manager to consistently beat the market. So there's a lot of truth in that statement, and Canada is a country overall where passive strategies have not been embraced. Canada is a country that where active management at a relatively high cost is the norm, and a best interest standard would have to look at cost intensely and say that for a large number of clients, the lower cost product would be the proper solution. So you have to, we would, in the best interest, focus on those compensation conflicts of interest. most even outside of the bank branches, but within the overall securities industry structure, the income of representatives and firms is driven primarily by production. So in that sense, the community of investors are an asset that is used for income generation. The more they sell according to their grids, the more they earn. When an advisor moves to a new firm, often those client assets are also treated as an asset of the advisor. It's his book of business that moves with him, and financial incentives are often created to induce those clients to move into the products of the new firm within a short order, putting the interests of the advisor and affecting that move ahead of the interest of his or her clients. So that's the type of conflict of interest that we say should be avoided. That is, it's those type of compensation conflicts in their baldest form can't be controlled by a firm, but they completely skew the investment advisory process and have to be avoided in the interest of the client. On that, thankfully, there is broad agreement. So even the provinces that are opposed to a best interest standard are prepared to regulate, so those conflicts would have to be avoided. Firms are required to know their customer, and there's a process that exists today for finding out the basic details associated with your financial situation. But there's no requirement of periodic updates. There are some norms in the industry. Some firms will do it once a year. Some firms will do it once every 2 years. If they learn about a significant change in your circumstances, they may update your KYC. But you should be really vigilant in making sure that your advisor knows your relevant circumstances and don't leave it to them to update that information. But we're going to mandate it for life events and requiring it periodically. A lot of firms complain that clients won't tell them financial information. There's a natural reticence to share information with the advisor, even though the advisor, all the stats indicate the advisors are extremely trusted by their clients. But one limitation is if we can't induce clients to share information, it's very difficult for an advisor to produce a rational financial plan. If they don't know your level of indebtedness, or they aren't in a position to assess whether it's better to pay off debt rather than invest new money, or they can't really consider your risk tolerance without knowing your position and your family's position in multiple accounts. So I think it's not for us to mandate the sharing of information by clients, but it is a necessary step to make this work on the part of clients in the future. Suitability, as indicated, is a bare suitability standard today, largely assessed on a trade-by-trade basis, and we want to move it to a portfolio suitability standard that looks at the totality of the account, and we want it not to be a bare suitability standard, but again, to be in the best interest of the client, which is a further and better recommendation than selling an affiliated product that is merely suitable. Merely suitable isn't enough to help Canadians, save for retirement or to preserve and enhance assets in retirement. We're also addressing the issue of titles and designations. Again, in this audience, I don't think anyone would be misled by a title of vice president, senior vice president, managing director at a brokerage firm, but almost universally, those external client-facing titles are a result of sales production. And a lot of clients are misled thinking that it implies expertise. We think, and there's basically a nuclear war, where everyone's having higher and higher titles and multiple titles and and designations, whether or not they are actually endorsed by the regulatory community. So we're going to take that on. On the other provinces The main reason they oppose a best interest standard is because they think it's hard to systematize. They think it's inappropriate to establish an aspirational standard where firms don't know the nuts and bolts of compliance. Our view is that we need to professionalize the advisory function and establish an aspirational standard that will evolve over time, that can be assessed in enforcement proceedings, compliance examinations, that will allow clients to question their firms about whether they are indeed acting in the best interest of clients. So there is that fundamental difference. The other provinces also argue that it's kind of an argument in favor of limitations on regulatory power, where if we establish a best interest standard, we have insufficient ability to implement it, and hence will be misleading the Canadian public. It's actually a kind of, in my mind, a sad commentary on their view of what we can accomplish as civil servants. There are limitations, but it's still appropriate to establish an aspirational standard and not say, you know, on day 2 after this regulation is enacted, clients will be misled because we won't have ultimately fulfilled, you know, the goal of best interest. I think we can do a lot, and I think it's kind of disappointingly limited to say that factor should prevent us from moving forward. The next initiative, which is closely entwined with best interest, is a potential ban on embedded commissions in the mutual fund industry. It's a fundamental conflict. We did a study, Douglas Cumming at York University led this work, and it was, and he had access to all the mutual fund flow information in Canada, essentially, and not surprisingly found that the trailing commissions that are paid to brokers actually dictated the sales effort and investment flows into those funds. That, again, that's a fundamental limitation on pursuing best interest because the brokers are being paid by the investment fund managers to sell their products. And that embedded commission, trailing commission that's paid to the broker, I don't think is well understood. We found it's not well understood. It's like many, again, less sophisticated clients think that somehow it's being absorbed by the investment manager rather than ultimately coming out of the pocket of the client. Of course it comes out of the pocket of the client. It's coming for, it enlarges the fee of the investment manager so they can pay that distribution expense. And the higher that payment to the broker, the more place that has on the broker's shelf and the more it gets pushed out to clients. It's just the most obvious thing. But you know, the industry does take issue with that. So we're, and there's another, obviously you've probably encountered deferred sales charge arrangements that where the payment is made to the broker by the investment manager up front, and then you're basically locked in according to a schedule. And if you redeem early, then there's a relatively punitive redemption fee that then supports the earlier payment that was made by the fund company to the broker. DSCs have outlived their usefulness. It might have been originally when front-end loads were relatively high, DSCs were, you know, perhaps a way of imposing some investment discipline, but now it's an extremely costly way of paying for advice. And it's one where a lot of clients in periods of financial difficulty have discovered that they can't take their money out without incurring a penalty. So we are looking at DSCs, and are moving, I think, towards a ban of DSCs and substantial restrictions on trailing commissions. What this will mean is that clients will have to negotiate directly with their advisors regarding the payment that they're prepared to give for the advice that they receive. Right now, it's an annuity paid to advisors with no standards about the advice that's given to a client over a period of time. It has a tendency to be viewed as an annuity, you know, by the advisor. And it's very difficult as a regulator to enforce a standard of service. Some advisors are fantastic, and they're going to hold your hand all along the way and really view the payment that they're getting as a payment for advice. Others do not. So if we can move to a system where people negotiate and pay directly, you'll have much more control over the service that you receive. Some of the naysayers say that Canadians won't be prepared to negotiate directly. They rather than getting the advice they need, they'd rather prefer the convenience of having the fee embedded in the mutual fund structure. I don't think that's the case, and I'm also convinced that for many clients who might find that convenience attractive, they're probably not receiving the financial advice that they need. So I think moving to a direct fee arrangement is the way to go. There's also a complaint that for many Canadians, it's quite possible that there'll be an advice gap created because in the absence of the trailer, advisors aren't going to give advice. I don't think that's true in the Canadian marketplace. I think the banks that have a cradle-to-grave approach are going to find a way to give advice. I think technological solutions, including robo-advice, will help fill the gap, and the many independent advisors among that registrant population I talked about will help fill that gap. So the third major area, which I think of as the flip side of best interest, is investor redress. And my experience has been that complaints in Canada against advisors, probably because of the trust relationship that's established or reticence to complain, is too strong a factor that Canadians have to be more willing to complain. And the industry and regulators have set up OBSI, the Ombudsman for Banking Services and Investments, which is a free service to clients that where you can take your complaint after a firm has not resolved it to your satisfaction. The firms have 90 days to resolve it and to let you know their decision, or after 90 days you can go directly to OBSI. OBSI collects the information, they apply a standard of overall fairness and determine whether compensation is necessary and appropriate. Firms, the structure that we had, because this was very controversial when it was introduced, is that OBSI can't make a binding decision. Their power is name and shame, so that if you refuse to adhere to an OBSI recommendation, you go on a name and shame list and suffer the embarrassment of not adhering to an OBSI recommendation. We found that has ceased to be effective. Name and shame, if you keep naming and shaming people, it ceases to be effective eventually. They begin to tolerate it. So we're doing two things. We're shortly going to issue a notice that's going to indicate that we view refusals to honor OBSI recommendations or settlements, lowball settlements that are below a recommended amount or in advance of an OBSI recommendation as something that will induce us to do further examination and see if there is, as required, a fair complaint handling process at the firm. And we're going to try and encourage people to honor appropriate OBSI recommendations. In the longer term, we're trying to move to binding authority, and we've gone to our Ministry of Finance in the hope that there can be structural legislation created to have a dispute resolution service, namely OBSI, with binding decision-making powers. So I also just wanted to talk quickly about some of the resources that we have. We have an investor office. We have an advisory panel. We have a seniors expert advisory committee. They're all doing excellent work. We have an excellent website called getsmartaboutmoney.ca. From there, you can actually look at the registration status of any individual registrant or firm. There's a discipline list, so you can look at the disciplinary history of the people you're dealing with. First and foremost, make sure they're registered, look at their disciplinary history. There's some calculators there that are really valuable. I find the mutual fund calculator to be excellent. So all of the mutual funds in Canada are populated in that calculator. You put in the name of the fund, the particular fund and mutual fund company, your anticipated holding period, and you can sort of cut through the Class A, B, C, and so forth to see what the actual cost is over that holding period. And when you compare two or more funds side by side using that calculator, you'll see dramatic differences in outcome, investment outcome. So it's very useful. There are investor alerts there. We've recently banned, for the first time to my knowledge in Canadian history, we banned binary option contracts, which are like short-term derivative contracts largely offered by fraudsters that are bets, like 30-second bets on the movement of gold, things like that. Very dangerous, offered, but they're being families torn apart, by these instruments, and we have banned them across the country. There's the new investment class that you have to be very wary about, that we're all wary about, trying to see how it fits into our structure of token, so cryptocurrency-related offerings. And obviously, with the impending legalization of marijuana in Canada, and there are a lot of marijuana-related offerings that have attracted both legitimate players but also fraudsters. So those are all covered in investor alerts. There's also some interesting research. There's a piece that was just published in September called Investing as We Age. And it was a survey of residents who were pre-retirement, Ontario residents who were pre-retirement but close to it. And it was quite alarming, and it's interesting reading to see the degree to which Ontario residents and even those in the overheated Toronto, or potentially overheated Toronto real estate market, were depending on their home as their source of retirement income. It's alarming. Like, the percentage was quite high, that 45% of pre-retired Ontario homeowners, 45 and above, are relying on rising home prices to fund their retirement. So that's a tremendous matter of concern for us. There's also some interesting stats in there about differing approaches to investment advice based on gender, and the way women will seek more advice, men will tend to be more self-reliant, and it's actually, but that, with no judgment about about the effect of the self-reliance. It's just a different investment style, perhaps, but it makes for interesting reading, and you can sort of, when you read it, reflect about your own style of investing and try and avoid some of the behavioral biases that we all have. So, I encourage you to contact the OSC with any questions through our contact center, or you can reach out to me as well, and I can address any of these issues or point you in the right direction. But, we're really committed to your retirement savings, making sure that there's an appropriate structure of advice, moving forward to a best interest standard, and ensuring that future retirees also have those benefits. So thank you for listening, and it's an honor to be here. Oh, do we have time for questions? Yeah, okay.
Questions, please.
Yeah.
So Grant, thank you so very much. This is very useful information for everybody, and I'm...
Has to be really close.
Closer. No, okay. So thank you very much, Grant. This is very valuable information for all of us. And I'm sure that we have time. We will take time for a few questions. We'll take 5 minutes for a few questions. So if any of you have interesting questions for Grant, take advantage. He is here, and he is representing the regulator, working on behalf of all the investors in Ontario, and up to a certain extent to Canada too. I mean, since Ontario represents 50% of all the investment, as I took from the first introduction.
Yeah. Please.
So anybody would like to? Yes, sir.
Thank you. I have two comments about ways I think investments can be a little more transparent. Firstly, when you get your annual report on your mutual fund, there's always a comparison of how your fund has done against the index,
Right.
or whatever the benchmark is for that fund. And you get it for 1 year. You also will get tables on how your fund has done for the last 10 years. I think it would be helpful if there was a comparison how your fund has done against the index for 10 years. Because people do not keep their books for 10 years. They might think, oh, this year the fund didn't do all that well. But by the time the report comes in a year, they've forgotten.
No, I think that's a valid point. And in fact, we're looking at, you know, the latest CRM reports, CRM2 reports that came out this year, and we're, you know, assessing the impact of that disclosure information on investors, and we're going to focus groups as well to try and understand if it's being comprehended and how it's being used. But I agree with you. That's one I'd like to see as an improvement. I'll take that back.
Okay. And my second comment is, I'm saying this as someone who does personal income tax. Mm-hmm. I find that most people who have mutual funds do not, outside of a registered plan, do not realize when they sell those funds, it triggers a capital event. And that's because fund companies and banks do not seem to be required to issue the T508, which is the tax slip, to the client. They issue it to CRA, but the clients don't receive them.
Actually, I didn't realize that. I assumed, for a long time I was in the U.S. and would get the equivalent information from my broker, but it surprises me.
And you commented that in the bank, the people who sell the funds are really just salespeople. If I send a client back to the bank and say, get the information, half the time the bank doesn't have a clue what they're being requested.
No, within the branches, we have had considerable complaints related to a lack of either follow-up on tax or even basic tax knowledge to impart to.
So I think it would be useful if these funds had to issue the same tax information slips to the government to their clients.
Oh, thanks. I'll take that back too.
Thank you.
Yes, sir.
Thank you. My question has 2 points. The first part is you talked about know your client requirements. In a self-directed situation, could you describe how the KYC requirements are reduced for an advisor? Because one of the concerns might be for some investors is that they're being asked for information which is really not required in a KYC situation. They're being asked for information that might be used for
Additional sales.
Exactly. And I guess rolling on from that, as you provide more information to any entity, as we see, information gets hacked, and only providing the minimum may be a safer strategy for a lot of investors.
Well, I think to a large degree, firms systematize their know your customer process through the use of questionnaires that elicit the basic information and then talk about risk tolerances. They do elicit information about other assets and goals and indebtedness. Beyond that, and I think that's having a user-friendly tool like that between an advisor and a client is a useful exercise. But and again, it doesn't work in all channels. In the lightest touch channels, it's going to have to be a more systematic process. But if you have a relationship with an advisor, I think ultimately it has to be a much more organic discussion. And perhaps those notes will be taken, but they'll be less hackable, certainly. And I think it's sort of inevitable that information that would be useful in making appropriate investment decisions and allocations would also incidentally be useful in sales activity. And as long as the sales activity is in aid of the best interests of the client, I think it's tolerable. Although I think you should always be in a position to say, I don't want any further sales contact. I'm giving you this information, for the purpose of establishing a portfolio and for periodic check-ins on my portfolio, but I don't expect to be called by an affiliated company offering a disparate service unless I authorize it. But without getting the information, they can't provide the professional service, like any professional.
But in a self-directed situation, isn't it the client that's fundamentally responsible for their own decisions? So does that significantly reduce the KYC requirement?
Only if it's unsolicited, and it's truly unsolicited. But the reality for many if you're using a self-directed account through a discount arm of a broker, that you're absolutely right. So you're do it yourself, and then the KYC information should be more limited. But a lot of self-directed holders are still dealing with an advisor and getting recommendations routinely and getting advice concerning the allocation of resources both inside the account and outside. So it really depends how do-it-yourself you are.
Thank you.
I'm sorry, we have a time constraint, but hold on to your questions and come after we suspend it, and Grant will be very happy to answer your question just after we have. Now, lastly, I have one last question just to end it, because our next speaker, his designation is CFA. So
right.
what are you what do you think about those CFA designation? I thought they have a well-acknowledged.
Absolutely. The CFA is not one of the designations. It's more the CFA designation would be one that we would acknowledge and do acknowledge for various purposes as one of the highest standards, and it's not problematic. So we would always use. We would always permit the use of a CFA designation. It's not a problem.
I want everybody to be comfortable with our next speaker,
Yes.
of course. So, thank you, Grant.
Thank you.